Good day, everyone. Cardinal Stone recently published its media outlook for 2025, and the reports provided guidance across the markets. We also reviewed our domestic economy, looking at different variables, and at the tail end of the reports, we provided asset allocation guide for investors. And for the first time in the history of Cardinal Stone, we included alternative investments for investors that are looking to get exposure beyond the traditional assets. Just to give you a bit of clue into the reports from the macro perspective, starting with growth. In the last 2 years, businesses, individuals, and overall the entire country have struggled to survive, given the fact that the policies of the government, the reforms that was initiated in 2023 down to 2024 that was extended into this year, had a bit of short-term negative impacts on the overall economy. But something interesting that we saw in 2024, or in 2025 rather, we're beginning to see a recovery. So for example, we tried to check business profitability. We used the NGX 30 as a guide for non-banks NGX 30 companies. We saw that we're beginning to see a recovery. FX losses, which have been prevalent in the past, because of the material FX devaluation that we've seen, are currently at pre-2023 levels, which means that recovery is taking place. However, the consumers are here to feel the impact, and we have a very good explanation for that. We'll try to look at other countries who have initiated reforms in the past. Typically, it takes a while between the time reforms are initiated and when the impact is felt on the citizen. In some countries, it took about 3 years. In other countries, it took about 5 years. In some places, even a decade, depending on how deep the economic challenges that the economy was facing before the reform. So, we think that in the second half of the year, business recovery will continue. We expect consumer recovery to also kick in, right? And that should be able to support improved GDP numbers. Overall, we're looking at GDP growth of about 4.1% before rebasing and about 6% post rebasing of GDP.
In the first half of the year, Nigeria's inflation witnessed a deceleration. This occurrence was instigated by 3 major factors. Number one, the impact of CBN policies resulted in the reduction in money supply. Number two, FX was relatively stable. And number three, there was sustained improvement in energy prices, which was orchestrated by sustained price cuts by Dangote Refinery. In the second half of the year, our expectations for inflation remains broadly positive. We expect the continued stability in FX and energy prices to actually lead to sustained moderation in inflation. Relatively on this front, Dangote Refinery announced the introduction of 4,000 CNG power truck, which is expected to ease distribution to major suppliers and retailers. On this note, we expect that inflation will print at a year-end number of 20%. For our currency outlook, we expect external borrowings of about $3.2 billion to support the FX reserve and also improve FX liquidity. This will support our year-end outlook for the currency. We expect the Naira to trade within the band of 1,550 and 1,635. So following our expectations for stable FX and energy prices, we expect year-end inflation number to print around 20%. This also inspires our outlook for the benchmark policy rate. We're estimating a potential 50 to 100 basis points cut on the monetary policy rates at year end.
So let's talk fiscal policy rate. We have an expectation of $65 per barrel for oil prices, and this is largely driven because of the OPEC+ supply that's supposed to hit the economy, the dollar economy sometime later this month. So with an expectation of 1.68 barrels of oil estimated average production per day, we forecast that the government's fiscal deficit might still sit around somewhere over 17 trillion naira. Right, as of the first half of the year, the government had net borrowed around 3 trillion naira. We think that the rest of the deficits will be borrowed in the second half of the year in order to fund the budget. Now, where would the government find the rest of this money? We think that government's borrowing will tilt more towards external sources. According to the Minister of Finance, Mr. Wale Edem, he stated that the government is looking to borrow the sum of $1.2 billion via the DMO and another $2 billion from multilateral sources at concessionary rates. So what we think this is going to do is the government now has enough firepower to be able to meet its foreign exchange denominated obligations when they fall due. As of November this year, the government has Eurobond maturities and coupon payments to the tune of about $2.5 billion. So we think that this tilt towards external borrowings shows that the government is thinking about its obligations, which is something that we think foreign investors are particular about, and they are thrilled about, given that the government is showing more fiscal responsibility towards its obligations. So what is the big picture of the reforms, the tax reforms? The big picture really is the government is looking to expand the tax nets, reduce loopholes in the tax law through harmonization of multiple tax laws, reduce instances of duplication of functions across multiple agencies. And the bigger picture really is, to expand the government's non-oil revenue in order to enhance long-term fiscal sustainability. So we think that the improved macroeconomic conditions actually bode well for Nigerian assets, both fixed income and equities. For fixed income, we expect the moderation in inflation to actually bode well for the CBN's monetary policy stance, and that could help with your pricing fixed income assets higher. And then also on the equity side of things, the likelihood of a lower interest environment would mean that equity valuations are likely to improve. In the equity space across our coverage sectors, we like the consumer goods business, partly because they are the recovery story as a result of the improved macroeconomic conditions I mentioned. It means that consumer wallets are likely to be more robust, and even the FMCG names themselves are starting to recover from the low base of earnings we saw last year. And then in telco space, aside from the recovery story, in terms of their balance sheet and profitability, we are also seeing that the full implementation of the tariff increases by the NCC will likely come in for the telco space, particularly the second half of the year. In the oil and gas space, we like Seplat and Aradel as a result of steps they've taken to improve and ramp up their production. In the banking space, we like GTCO, Zenith Bank, and UBA due to the robustness of their balance sheet, particularly in terms of the recently raised capital following the CBN's directives. We also like their diversified earning base. For UBA, for example, they have quite a number of subsidiaries across Africa, which will support earnings profile going forward. GTCO as well also has a robust balance sheet profile in terms of low regulatory forbearance from the CBA. And so we think that these stocks are likely to perform well in the banking sector.